Taxes and Income, Lesson 5, Tax Brackets. In this lesson, you'll learn what the IRS is, what tax brackets are, how they work, the difference between federal and state income taxes, as well as the importance of understanding how to use tax credits and tax deductions. We can't emphasize it enough. You need to know how taxes work and how they're going to affect your paycheck. Taxes are most likely going to be the biggest expense that you pay throughout your entire life. And here in the United States, we use what's known as a progressive tax system, or sometimes referred to as a graduated tax system, which means that the more money you make, the more money you pay in federal income taxes, and the less money you make, the less money you pay. The Internal Revenue Service, also known as the IRS, is America's tax collection agency. They oversee the collection of taxes, mainly income taxes, and they also enforce federal tax laws. So if you try to cheat the system and not pay your fair share of taxes, they can take legal action against you, which is why so many people are afraid of making mistakes when it comes to filing their taxes. Nobody wants to deal with the IRS investigating their finances. The progressive tax system uses what's known as federal income tax brackets, which are basically just different categories to help the government tax you appropriately based on your income level. The current tax rate for single filers, meaning you're not married, is broken down into the following tax brackets. If you earn between $0 and $11,000 in taxable income per year, you'll be in the 10% bracket. If you earn between $11,001 and $44,725, your highest bracket is going to be 12%. If you earn $44,726 to $95,375, you're going to move up to the 22% bracket. As you can see, it just keeps climbing from there, capping out at 37%. The more taxable income you have, the more money you owe in federal income taxes. As of 2022, the average American, who is a single filer, pays 28% in federal income taxes. And just as a reminder, most states have their own income tax that you have to pay in addition to the federal income tax, which we're going to explain later in this lesson. The government decides how much money you owe by breaking your taxable income into different chunks or brackets, and each chunk gets taxed at a specific rate. Just because you're in a specific tax bracket, that doesn't mean that you'll pay that federal income tax rate on everything that you earned. Let's look at a couple of examples that should make this a little less confusing. Let's say Emily is a single filer and she makes $34,000 a year of taxable income, and that puts her in the 12% tax bracket. But she's not going to pay 12% on all $34,000. She'll pay 10% on the first $11,000 and then 12% on the rest of her income. Example number 2, let's say Tanya makes $55,000 of taxable income in a year, which puts her in the 22% tax bracket. She's going to pay 10% on that first $11,000 and then 12% on the chunk of income between $11,001 up to $44,725, and then 22% is taxed on the rest of her remaining income. Keep in mind that this progressive tax system is only for federal taxes. There's also state income taxes. A state income tax typically taxes income that's earned within that specific state. The money generated from taxes generally is used to fund state budgets rather than funding the federal government. And depending on the state that you live in, they may use a progressive tax system with the same tax brackets, or they could have different tax brackets. They may charge a flat tax where everyone pays the same regardless of income, or they might not even have an income tax at all. We covered this in lesson 3, but it's important to go over it again for this lesson. There's 9 states that don't require you to pay additional income taxes on the wages that you earn. Those states are Alaska, Florida, Nevada, South Dakota, Washington, Texas, Wyoming, Tennessee, and New Hampshire. And as you can imagine, not having to pay additional income taxes means you just get to keep more of the money that you earned, which can make it easier to pay your bills, set aside money for your retirement, or just have money left over so you can enjoy your life. The other 41 states either have a flat income tax or a progressive income tax. If you make a lot of money, some states like California can hit you with an additional state income tax up to 13% in addition to the max federal income taxes rate of 37%. Again, as you learned in lesson 3, local income tax is a type of tax some local governments impose on people who live or work in a specific area, such as a city, a county, or another area. Only states with a state income tax can establish local income taxes. But living and working in a state that has a state income tax doesn't necessarily mean that they're also going to have a local income tax. There's only 17 states that have both state income tax and local income taxes. If you live in one of those states, just know that you're going to have to learn to get by with less money because more of your paycheck is going to go to local, state, and federal income taxes. And according to TurboTax, the average American pays 9.9% in state and local taxes in addition to their federal taxes. Using deductions can place you in a lower tax bracket, which can help you pay less money in federal and state income taxes. The two most common ways of reducing your tax bill are by using tax credits and tax deductions. Based on your filing status, current life events, and the amount of money that you earn, or the amount of income that you earn, there are different deductions that you can qualify for. And the IRS has very specific criteria that you have to meet in order for you to claim those tax credits and tax deductions. Both states and the federal government offer tax credits, which can be dollar for dollar reductions in the amount of income tax that you owe. They're designed to encourage behaviors that the government considers beneficial to the economy, the environment, or other purposes that they deem important. So, for example, the government will incentivize taxpayers to protect the environment by offering a tax credit for purchasing solar panels for your house or buying an electric vehicle. Tax deductions are things that you can subtract from your taxable income, which can then put you in a lower tax bracket and legally reduce how much money you have to pay the government in taxes. Examples include things like credits for having kids, or paying interest on a home loan, or student loans, or writing off operating expenses if you own a business. Now, most of these things don't apply to you yet, but it's important to know about them for the future. Here's the catch. When it comes to tax credits and deductions, you don't get to claim them until you file your taxes the following year. And this is where tax refunds come from. You have to pay taxes all year based on your income tax bracket, and then if you qualify for any credits or deductions, you get the money back because you technically paid the IRS more money than you owed. You just learned what the IRS is, what tax brackets are, how they work, the difference between federal and state and local income taxes, as well as the importance of understanding how to use tax credits and tax deductions. While taxes are used to fund local, state, and federal governments, which are good things that we need, keep in mind that the more money you pay in taxes, the less money you have to live on every month. In the next lesson, we're going to walk you through filling out a W-4 for your employer.